Welcome everyone to today's webinar. Let's do a quick audio and well, I guess it's probably working so far. Should be good. What we're gonna do today is we're gonna talk about swing trading for one more webinar. And if you remember, when we talked about swing trading for the first couple of webinars, we mostly focused on you know, your classical swing trading that you can apply really to any asset class, and it doesn't matter whether that's stocks or bonds or currencies or commodities. It doesn't really matter. But again, to kind of recap, what's important to keep in mind here when we talk about U.S. stocks, U.S. equities, is that we do have a market that, all else being equal, is fairly orderly, which is to say that it's a market that has plenty of liquidity. It has regular news flow. So the news flow, at least from an economic data point, is usually is not a surprise. We know when the data is coming. The actual data itself may be a surprise here and there, but the actual scheduling of the news is orderly. It happens within certain time periods, and again, that's one of the quote unquote drawbacks that we have in the currency market, is that the news really is 24 hours a day, and that's just a little bit different, makes things a little bit more difficult, because if you have news flow that the whole day that can move the stock market, market, then you really kind of have to be focused on the market the whole day, and that to a good extent sort of defeats the purpose of what we try to do. Specifically, we talk about swing trading, and again, today's topic once again is swing trading specifically. So, the great thing about swing trading stocks is, again, just to recap, good order flow, good news flow, regular. We know when the news comes out. We may not know what the news is going to be, but we know it is coming out. We know that there's a lot of liquidity. As long as you stick with the liquid stocks and the ones that report on a regular basis, really, it's difficult to really mess up in a big way from a swing trading perspective. Of course, it all comes down to risk management, and that's actually really kind of the topic I want to focus on today. Within the spectrum of risk management is the whole idea of risk management. What does that mean? Because a lot of people can put on a trade. Everyone can look at a chart here. We're looking at the chart of Apple, which is live right now, and you could make the case that you could always make a case, a buyer. Or excuse me, this is not the case of Apple. This is the chart of Netflix. My apologies. But my point is, you can always make the case for buying or selling something. The problem usually comes when you're in a trade, when you have a position on. What do you then do? Because a lot of people cannot handle the psychological effects of having the pressure of a trade on, which is difficult, But with some practice and a very clear focus, it's not something that is impossible. In fact, it's very, very possible, and it's very, very doable. But again, it takes, like everything in life, it takes practice. And so I wanted to start today's presentation off with a little bit of a rant on this, in a positive way, of course. Again, just kind of focusing on the fact that trading and investing is not something that you're going to learn in a day or two. In fact, you're not going to learn it in a week or a month or maybe not even in a year. But you will learn it and you will get better if you stay dedicated to it. So I want to make sure that we're now, I think we're scheduled to do 16 of these webinars in this webinar series. And the common denominator among the topics that we're talking about, which again ranges from technical analysis about why we want to trade U.S. stocks as a versus foreign exchange, pros and cons, swing trading, day trading, various strategies, and now risk management as well within the realm of swing trading. The common denominator really is that there's a lot to learn. And again, I don't mean this to say that it's impossible. It is very, very possible. I know it's possible because I'm doing it, and I know I have a lot of students who are doing very, very well. But again, they're not learning it overnight, and I just want to, since we're doing this extended webinar series, I want to make sure that we're also being honest about the fact that it does take time to learn. But again, like anything in life, if you can stay dedicated and committed with a plan, then really it ultimately should just be a matter of time until you actually succeed. So, having said that, let's just quickly recap why we want to consider swing trading as opposed to, say, trading or long-term investing. Well, there are various reasons one would want to consider swing trading, and maybe let's first define what swing trading is. Swing trading really, at least by my definition, and I think this is mostly the broad definition that other people would apply as well, is when you trade an asset, again, this could be a stock or a currency or whatever, between, let's say, at least 2 days to probably multiple weeks, right? In other words, let's say you buy Apple today, and you're gonna sell it maybe in a week from now. That would be a swing trade. Now, some people that are pure day traders would argue that you can certainly do swing trading within the day, within day trading, and that certainly is true as well. You can certainly put on a trade inside of the day and call it a swing trade. But the classic definition, if you hear someone talk about swing trading, most of the time is talking about a time frame that extends beyond the intraday, and again is really more focused on multiple days to multiple weeks. So that's your classic definition of swing trading. Now let's talk about why someone would want to consider that type of trading versus day trading, for example, or versus a long-term investing. Well, I'm right now I'm actually in Orlando, in Florida, and I just finished off a 2-day workshop with some students, with some clients, and we just spent 2 days in a nice hotel here in a nice meeting room, doing some fun activities as well. But we really focused a couple of days on building their trading plan, trying to find out each person's weak spots in terms of trading, where they could improve, where they're already good, And what we did yesterday was we specifically focused on each person's personality. So everyone in the room had a task to basically write down, what type of trades they feel comfortable with. Is it a short term, medium term? Maybe it's a longer term kind of thing, or maybe it's something where they keep a core position on, like say maybe they own the shares of Apple, and then they just kind of buy and sell a little bit of Apple around it. We call that trading around a core position. And so that's number one, because each person has a different personality. And number two, and I would argue at least as important, if not more important actually, is what everyone's time availability is. And the reason I'm telling you this today is because time availability is equal to what realistically you might, what type of trades you realistically can do um, as a market participant. So for the most part, and I'm speaking here on behalf of at least my type of clients, which is a very good representative sample of most people. They have jobs, they work, or maybe they are retired or semi-retired. The point is they don't want to, nor do they have the time to spend the entire day in front of their computer, right? So think about it. If you have a job, which I'm assuming most of you do, or again, maybe you're retired, you are supposed to be doing the work at work of the job you're working at and not supposed to be trading. In fact, you most likely won't have time to do so because you're busy doing your work. So considering that, if you fall into one of those categories that I just mentioned, which is, again, the vast majority of people, then day trading really is not something that's reasonable for you, because day trading focuses on being able to be undistracted during the day when the market is open. Now, this goes a little bit back now to the idea of swing trading. Excuse me, of currency trading. Some people like to trade currencies simply because they think they can just do some trades at night when they come home from work over dinner or after dinner. The problem with that is, and I discussed this in the previous webinar, is that if you do so, you are going into the market and randomly looking for an opportunity. There's no, unless you know specifically at 9 o'clock at night or 8 o'clock at night, whenever you finish dinner, unless you know statistically that there is a good trade to do, 2 or 3 or 4 days out of the week, maybe less, intraday, like a day trade, and you know that, and you know why, and you know the currency you're looking at. Unless you know that, most people don't, because it's very, very random. You really should, in my opinion, not be doing any type of day trading like that. So if we now consider a more reasonable solution to this, which is really swing trading, think about this. How would you feel if you could, before you go to work, maybe do a little 15 minutes of research, and then you go to work, you have your phone with you, your iPhone or your Android phone, whatever smartphone you have, and you can check on the market throughout the day, but not a lot, because you're still busy, you're working, or if you're retired, it's the same thing, right? You don't want to be spending the whole day in front of your computer. But you can go in and you can check what the market is doing, and maybe at some point you execute a trade, but it's not a day trade, because if you put on a day trade, you really have to watch it. And I know some people would disagree with that, because arguably you could put a stop and a price target, but the suspense of being in that trade for such a short period of time is usually going to mess with your head, and you're then going to check it every 2 seconds, and it just makes your life miserable. So that's the norm. That's what most people fall into. But if you look at the market a couple times a day on your phone, or maybe on your computer at work, and you don't actually have to do a trade, you just watch it, right? And your time frame is more than just one day. It's a few days, a few weeks, maybe it's more. You psychologically get into a much better spot, where you can now risk manage your trade much better. In other words, you are not going to be as hectic or as stressed when you have to stop yourself out, because just the way the mind works, I guess, is the simple answer. And then when you come home, you might do a little bit more research, Maybe you look at the market for another, 15, 20 minutes, maybe 30 minutes. Maybe you put on a trade. But again, it's not a day trade. You're putting on a trade. Maybe you put on an order to buy some shares of Apple or whatever you might be doing, and you look to see, how that stock is going to then do for the next few days or maybe few weeks. So you can see that swing trading, at least the way I like to think of it, is a much less hectic way of trading the market, because you're not forced to look at it intraday. And I will tell you that it's ultimately proves to be much more profitable than swing trading, than day trading, excuse me, because day trading is so hectic. So what ends up happening is that when you day trade, you basically stress yourself out, and then you can't focus on anything, neither your work, your life, nor on trading. So it's kind of a vicious circle. Now, one other way of thinking about swing trading is that most people don't have, like I said before, the time of day trading, because that means you have to be in front of your computer for the most part. Number two, if you are a long-term investor or long-term investing, which means you buy something today and you maybe sell it again in 1 year from now, for most people that's too boring, right? And I can imagine you can a lot of people that are interested in trading wouldn't consider that trading, and in fact that isn't trading, that's investing. So if you buy something today and you're going to sell it in one year from now, that's not really very exciting. But again, trading shouldn't be exciting, right? That's the other thing. But if you have an approach to the market where you look at the market, like I said, a couple times a day, 2-3 times a day, 10, 15 minutes here and there, maybe 20 minutes, and you have some positions on, you have your clear stops and profit targets set, so you don't have to worry about being stressed out about if you're in a meeting. What if you're in a meeting? What if you're in a meeting and you have a crazy day trade on? You won't even be able to finish your meeting at work, right? But with swing trading, it's all much more calm. In addition, and this is the last big point on this, it's important to note that the swing trading opportunities are actually much higher probability, and here's why. So if you're a day trader, by definition, and there are many of them, you really only can focus on trades that are happening inside the day, by definition, right? Otherwise, you wouldn't be a day trader. But if you're a longer-term investor, like most institutional investors are, you can't excuse me, you can't focus on swing trading because it's too short for you, too short term. So what that means is that all of a sudden you have many more opportunities, and they're much better because of that, in this time frame of a few days to a few weeks to maybe a couple of months, right? So swing trading really is a pocket of the market, or an area of the market that's what I would call uncrowded, okay? And that's really, really important to understand and respect, because it's once you understand and respect that, you'll have an easier time, at least trying swing trading. It may not be the holy grail for you. Maybe your personality is to just buy something today and sell it in a year from now, or maybe your personality is a day trader. But what I have found, and I've done this a long time and have many clients and students, I have found that without a doubt, the time frame that fits most people's lives better, the best, I should say, is the swing trading time frame. Again, why? Because most people have jobs. Most people have, some sort of maybe family commitments or other hobbies, right? Or maybe, again, like I said before, they're retired, or they have to travel a lot, for their job, right? So making it even more complicated. So given most people's circumstances, a day trading approach is very difficult to come by. I discussed in the last webinar, I believe, a little bit about day trading. We'll talk more about it though. So there are ways to do day trading, but there has to be a very specific approach to that. Okay, so now that I've talked a little bit about making the case for swing trading, and again we've already done a couple of webinars on swing trading. Let's go through and let's look at a bunch of different stocks that might be interesting to analyze at the very moment for trading. So what I'd like to do is I'd like to go through and look at a few current stocks that are interesting. So one of the stocks that we analyzed yesterday in my workshop, mastermind workshop seminar here in Orlando with my students is Netflix. So I'm going to walk you through and show you right now exactly what we looked at with Netflix and why we traded it and we bought it and why we still own it for a trade. So let's quickly paint the picture. For those of you that have been here before, you might know that I use some very simple moving averages to give me a little bit of context. And those moving averages look like this. We have a 50-day moving average in yellow. We have a 100-day moving average in blue. And finally, we have a 200-day moving average in red. Maybe one quick word on these moving average again, just as a reminder. I like to use moving averages mostly for points of reference, and I will show you this in just a minute on two specific examples that I want to go through one more time with you. Because if you use moving averages for your only determinant to buy a stock, so if the only reason you're going to buy a stock is because the stock is going above or below a moving average or something like that, that's a very low probability way of trading. So what we want to go through here is the analysis of shares of Netflix. So let me just draw you a little bit of a picture here, which looks something like this. So you can see number one is this sort of area of resistance. So let me just do it like this. I guess I can't pull it down, but you can see what I'm trying to get to here. We've had a Netflix, a stock that had very clear technical resistance around $130 several times over the past time period here that we're looking at, past couple of years. So one time here, we found resistance at near $130. Again, this is this blue zone that I just marked. Then one more time here, a third time here, and then finally we rallied into this area late last year, late 2016, and we started to slow down. We didn't fall back. As you can see, there's a very different price action that took place here as compared to here. Right? Here you had quick rallies and then a very quick sell-off. Quick rally, quick sell-off. Quick rally, quick sell-off. But here we had a quick rally, albeit a more orderly rally, and we didn't sell off. We just consolidated, basically. And then what happened, and I'm going to zoom in a little closer, so we consolidated. You can see we didn't do this, right? We just kind of stalled. And then you can see the company had reported earnings, I believe it was on the 19th of January, so that's a few weeks ago. And the stock gapped higher. It's this move here, this empty space you can see from here to here, from here to here. And as a result, the stock basically broke out of this long-term resistance area, and again, long-term may be a bit of a exaggeration here. Some people wouldn't call a couple of years long-term, but for argument's sake, That's what we're looking at here. But you can see we had a nice breakaway gap. And what happened is the stock then, instead of continuing to rally, it then basically went sideways. So what we had is we had the stock, oops, we had the stock do this, right? And then yesterday, if we look even closer, in fact, if we draw the line like this, you can see we actually moved higher, right? So we broke out of this consolidation range, and that's a very powerful thing to see. So, from a swing trading perspective, I would make the case here that Netflix looks like an interesting stock. Again, this is, to be clear, this is not a recommendation. This is simply something that I'm looking at. I personally own a little bit of Netflix now, so I'm just showing this for example purposes, and because I just analyzed this stock with my students yesterday. So Netflix to me is a stock that has a price target probably around $150 as the next price target, maybe a little bit less. We have to see. We have to see about that. But the question is, what happens if the stock now quickly goes back down? What would you do? Now, this is where we start talking about risk management. And the thing about risk management is that every person has a different way of handling risk, a different level of risk aversion. And the more risk averse someone is, the less that person is said to be willing to take risk. Excuse me, the more risk averse someone is, the thing is what I said, the more risk averse someone is, the less willing they are to be taking risk. So to me, and there are of course many ways of doing this, but to me, when I see a stock rally like this and break out like Netflix did yesterday, and again, right now I own the stock for a trade, I would most likely get back out of the stock if it were to give us what I call a bearish reversal or just fall back into this range. Because if that happens, then the entire breakout basically has been negated or erased, if you will. In which case, you then once again would have to wait for the stock to give us another potential breakout, and then maybe get back in again. Okay, I hope that makes sense. Now, one of the biggest, most difficult things that for people to do is to buy a stock once they have been stopped out of it a couple times. So let me show you what I mean. So maybe you were looking to buy Netflix, and you were looking to buy it here because you thought that maybe the stock is going to go higher and break past this point. Well, obviously it didn't work, so hopefully you would have stopped yourself out. Well, it happened again here, and this is quite a bit later, and maybe you tried it again. Well, guess what? It didn't work again. Well, usually if someone gets stopped out twice, most people then they stop looking and then they just kind of walk away and not consider it anymore. Well, look what happened here. Here we finally got to this point, and here it did work. So after, most people would have stopped trying to buy the stock higher because they got stopped out twice. But now here in the third time, it finally worked. And that's one of the big tricks about trading. It's being able to understand that sometimes you have to try trades several times in order to finally get a trade that's working. And which is funny because if you really think about it, people understand that in life. People understand that, in life sometimes it takes several attempts to do something. You don't expect to become a professional tennis player after one lesson, right? Yet a lot of people think that all they need is to open up a broker account and some money in it, and they should be able to make money in the market. And that's not really how it works. So again, I want to focus today more on risk management than anything else, because if we can risk manage or control our risk, and we really we will all ultimately we will automatically start making money. So the goal in trading, and I'm sure a lot of people have heard this before, is to try to minimize your risk or minimize your losses, I guess is the better way of saying it, and trying to maximize your gains. Now, I will tell you that I think it's much easier, despite the fact of what one might think about this, logically speaking. I think it's much easier to try to focus on limiting your risk or controlling your risk, or limit, or keeping your losses as small as possible, than trying to maximize your winners, your profits when you have a winning trade. And the reason for that, at least for me, and I have actually seen this with many other people, in fact, most other people, but the reason for that is that trying to hold on to a winning position, a trade that's working for you, is, I think, even more difficult because you now have profits. And a lot of people want to take these profits, unless they are very new at trading, in which case they think it'll continue forever. But anyone that's been trading for a little bit of time, they understand the value of taking a profit. So when they have a profit, they want to take it. They want to, close the stock and close a trade and book their gains. And for the most part, it's not a bad idea, right? But it's very difficult to maximize your gains that way, right? So that's exactly why I'm saying that I think it's easier to focus on limiting your risk or cutting your losers short than letting your winners ride. So considering that very simple fact, I would argue let's try to focus on reducing our losses, or making them smaller, rather than trying to make the winners bigger. So I think there's a really a very significant difference there, and I hope this is coming across as valuable information. So let's look at a couple of stocks that I want to focus on, and I want to look at this from a swing trading perspective. So number one is Apple, and I want to show you something here in Apple that I consider to be extremely valuable from a swing trading perspective. So to me, the highest probability swing trade happens when multiple things come together. And when I say multiple things, it's news. It could be something technical. Most likely, most of the time, it's something technical. It's multiple technical things, in fact. So let's have a look. So again, just to recap and make sure you understand, the red line here is the 200-day moving average. The blue line is the 100-day moving average. 100-day moving average, excuse me. And the yellow line is the 50-day moving average. So the point I want to focus on is actually this point right here. Or we could focus on this point as well. Let's focus on this point first. So let's see what happened. So we had a nice rally. So the stock moved higher. And then it started getting tired here. So let me zoom in. Okay, so we're looking at this point. So we had a nice move higher. And the stock came back. But let's see where it came back to. The stock came back to a point where both the 50-day moving average, that's the yellow line, and the 200-day moving average came together. In addition, the stock came back to this previous low here, which also held as support. Okay, so we have three things happening here: 50-day moving average, 200-day moving average, and horizontal support from those previous lows over here. And thirdly, or actually the fourth point, is the strong what we call bullish outside reversal day. Candlestick analysis 101. Look what happened. The stock dropped higher 2 days in a row. On the third day, it tried to push lower, but then quickly rallied higher, fully engulfing that previous day's price action. Right? And then the next day, the stock gapped, is what we call it, gapped higher. Let's look at the other point, the other trade here in Apple. And what we're looking at is this point right here. So again, note that the stock rallied very strongly, and you could take it either from here or from here. Very strong rally. And then ultimately the stock pulled all the way back to its red line. Again, that's the 200-day moving average. But you can see that it wasn't just the 200-day moving average the stock came to. It's also this horizontal blue box that I drew in, that I painted on the chart, where the stock came into, right? So that's the second thing. So it's the 200-day moving average and the horizontal line. Thirdly, if we now take our Fibonacci retracement tool and we go down here, we move it back up here, hold on, here, you can see that we came back, we retraced 50% of this entire move. So from here, back up here, we came back 50%. I don't know if you can see this little number here. If you can't see it, it doesn't matter. I'll show you. So let's count. So we had the 200-day moving average, that's 1. Number 2 is horizontal support. Thirdly, we had Fibonacci retracement. And number 4, which ultimately is the most important, is what we call a bullish reversal. Let me show you what that means. So what we had here was Apple sell-off, and you can see the stock fell lower, and on this day, the bears, the sellers, could no longer keep the market down. They still closed it negative for the day, but well off the intraday lows. Well, the next day we have what we call an inside day, and then the day after that we had a follow-through buying day. What that's telling us is that the sellers got exhausted. There were no more sellers left. In this time frame, there were no more sellers left. And the fact that this happens at a point where the 200-day moving average coincides with this area, this horizontal area line, in addition to the Fibonacci retracement, which is 50%, and actually 50% is not a Fibonacci number, but either way, from this entire move up, we retraced 50%, so half of it. That's very powerful. That's a very powerful move to make. So you can see these confluence zones for swing trading are extremely important. Now, it's important to understand that these types of setups don't happen every day in every stock. If you look at Apple, we haven't really had a lot of these. We've had a couple here over this time period, and that's something that once again speaks to the importance of being patient. We want to be patient traders, and that's another great benefit of swing trading, because if you're gonna do swing trading, what happens is that you understand the value of being patient. If you are a day trader, it's very difficult to be patient. Now again, a good day trader will of course also understand the value of being patient, but because inside the day there are so many opportunities, it is very difficult to stick to remain patient. But with swing trading, you know that any given stock is only going to give you a valid, really good buy or sell opportunity, maybe a couple times every quarter, every few months. Right? That's on average how many good opportunities you get realistically. So when we look at day trading, then just to compare it one more time versus swing trading, really good probabilities on a day trading perspective don't happen every day. So let's say you were to look at, whatever, let's say Apple stock. If you were to day trade this, you only get maybe if it's really if it's a great week, you get one good opportunity every single day. I think from a day trading perspective, you won't get more than two or three most, if any at all, even for day trading. So, that's another point here about swing trading is it's really important. Okay. Now let's talk about another trade that I want to show you, and this one is in the S&P 500. And I'm just trying to show you how these confluence zones, these confluence areas, are so important when it comes to swing trading. And again, it's the same analysis for day trading and any other type of trading as well, any other time frame, I should say. Excuse me. But specifically here, we're focusing on swing trading, of course, in today's webinar. So let's look at a couple of points, and I will zoom in a little bit closer, and you will see them taking place. So number one, what we're going to focus on is this point right here. All right. Now, you can see that this point in time has had some historical significance. Right? If we zoom in close enough, this used to be support, then it broke, and became a little bit of resistance. Then we broke above it, and then it became support. So when the S&P 500 had a little bit of a couple of down days here, it found support in this area, which we could have easily seen by drawing this line. Well, number two, you can also see that yes, the S&P 500 broke below this red line. Again, that's the 200-day moving average. But you can also see that the S&P 500 only stayed below that 200-day moving average for 1 day. 1 day only. And then it quickly went higher, back above it, and then we gapped higher the next day, and then we rallied again. In addition, if we take our Fibonacci tool, we take the lows here to the highs, you will see that we retraced an exact 38.2%. That's a Fibonacci number and important support. So we have three things come together, and of course price ultimately, which was a strong bullish reversal. Let's look at the next example. Let's look at the lows in the S&P 500 from I believe it was June of 2016. So that's last summer. So once again, we see the market rally, the S&P rally, right? It then came back down and touched once again that red line, the 200-day moving average. That's number one. Well, number two, we could have also drawn here this line, because you can see that used to be resistance. Well, now it became support. Again, we broke below it for a little bit, but not much. Okay. And thirdly, if we draw a Fibonacci line, okay, we take the lows here, we take it up to the highs, these highs here, we retraced 50%. Okay. So we have a really, really important support area that took place here with several things coming together. Number one, most obviously, the red line, the 200-day moving average. Number two, horizontal support, like I just showed you. And number three, the Fibonacci retracement. Or it actually was, again, it wasn't a Fibonacci retracement because 50% is not a Fibonacci number, but nonetheless, an important retracement. Okay? So these are what I consider to be some of the highest probability ways of making money in swing trading, is finding these so-called confluence support and confluence resistance areas. So let's see if we can find a stock that right now is giving us an opportunity. And of course, I've come prepared with one. And the one we looked at or are looking at is a company called Schlumberger. This is an oil services company. And to me, the stock is increasingly looking interesting. And let me show you why. Okay, now to be clear, we have not yet had any price confirmation. The stock is not yet going back higher, but it's certainly worth watching. So let me show you what I'm seeing. Well, number one, you can see that the stock has come back to its 200-day moving average. That's this red line. Once again, you can see I always draw the moving averages using the same color because I think that's really important. Number two, we can draw some very simple lines that look something like this. Okay, so I'll draw another one up here. And you can see that basically, for the most part, this stock has been trading back and forth, back and forth, back and forth, back and forth between these two blue lines, right? You can see that. So we are, number one, we're coming into the lower end of the range. We're bouncing into the, or falling into the 200-day moving average. And thirdly, let's see if we can take the most previous low here, these lows here, and see if there's some sort of significance here from a Fibonacci perspective. And sure enough, you can see we're exactly at 61.8%. 61.8% is a very important Fibonacci retracement. In my opinion, it's the most important. So the only thing that's missing now is price confirmation. And again, like I said before, that's the most important thing to see is price confirmation. We have not yet seen price confirmation, and it's the most important thing that we need to see in order to have a successful trade. So let's zoom in on this a little bit closer and see what we need to see in order for this to become a buy. Because right now, it's not a buy, it's just there, right? Well, what we need to see is some sort of buying pressure. Let's look at the previous two lows. Let's look at what these two lows look like. You can see it here. We fell down, but ultimately we had buying confirmation here and an even better one here, right? Same thing here. We fell lower and then we had a forceful, strong bounce higher. Same thing here. We fell lower and a forceful move higher. Well, obviously, we are not yet seeing it here. So that's the number one thing that we still need to wait for in this specific stock. Okay, so let me just walk you through this one more time. And this is the kind of stuff, by the way, that I do in my Clubhouse membership, which is where people get a video every single day with ideas like this. You know, I find these ideas, and so let me show you. Okay, so once again, you can see that we are trading in this channel, or have been trading in this channel. We're now once again at the lower end of this channel. Now, at this point, by the way, the stock is either going to bounce or it's not going to bounce and it's just going to fall apart. Both things are very possible until we see some sort of confirmation bounce. We obviously have not yet seen one, So it's a little bit silly to make a trade. And a lot of people, unfortunately, would at this point already go in here and buy the stock just because it came down here. But that's, in my opinion, over time, a very dangerous trade to do because of the simple fact that that we have not yet seen any confirmation. So far, the sellers are still in control of this stock. Visibly, you can see it. They're still in control of the stock. But once we see buyers come in and give us some sort of buying confirmation, that picture changes very quickly. And that would give us the confidence to go in and say that this confluence support area that I just talked about, again, we have the 200-day moving average, we're at the lower end of trend, and we have an exact 61.8% Fibonacci retracement. All these things together, but most importantly, the price confirmation would then finally give us a high probability trade to buy the stock. Okay. So let's talk about what a potential upside target might be. Well, that's going back to my point before, saying that it's more important to focus on the risk management than on the than on trying to ride your winning positions higher. So to me, as a general rule, and this very much depends on the volatility of the stock, but if a stock has rallied 5%, I certainly take first profits, at least some profits. It's a very general rule, and again, it's difficult to say. You can't apply that to every stock the same because again, every stock has different volatility. But that's a simple rule. Now, if we're trading an index, something like the S&P 500, or maybe you're trading the DAX, the German DAX. If I am doing a trade and the index goes up or down in my direction, in my favor, 1-2%, that's a pretty good move already. Again, even there, it depends on the volatility of the market environment at any given point. But if I were to give you an average, like a real basic law or low buy, that would be the one that I would give you. So again, to recap, we talked now for I think 3 webinars extensively on swing trading, and I hope I've been able to shed a little bit of light on swing trading and the advantages of it to you and for you, and that you can ultimately see if this is something that you want to do, or if you're indeed more of a day trader or more of a long-term investor. Whatever the decision is that you make sure that you give it enough time. If swing trading is indeed something for you, for interesting for you, then you want to make sure that you give it some time, because like I said before, any worthwhile endeavor is going to take time to learn. You don't become a professional tennis player in a week or a day, or certainly not even a month or a year, but it takes time. And it's the same thing for trading, regardless of your time frame. So I hope this made sense, guys. I want to thank you for attending. If you have any questions going forward, I'm sure you can send them over to Roboforex. I'm happy to answer them if they pass them on to me, and I will see you guys in the next webinar. Thank you.